Hello again, Lance Browning, Income Solutions Wealth Management. Tyler, hope you're doing well. It's getting really hot outside, and that can only mean one thing. It's time for our halftime report. As we're trying to show you here on this intro slide, the Fed is in quite a bit of predicament. They're having to maintain a pretty precarious balancing act between controlling inflation and still maintaining economic stability. We talked in last year's halftime report, as well as throughout this year, about some indicators that we can use to help us determine where the economy is going. We called them our Big Four indicators. The first one is going to be something called the U.S. Treasury yield curve. So basically, the premise is that the longer you tie your money up in a bond, the higher the interest rate that you will receive. Common sense, right? Here you see that shorter term bonds, upper left, and notes are paying more than longer term bonds, bottom right. This is what is known as an inverted yield curve, or as we say in East Texas, this is kind of bass-ackwards. An inverted yield curve is usually a pretty good recession predictor. A second big indicator we use is the money supply in the economy, what we call M2. And it's a total of all money that's in the banks in the economy. And note, there's a very strong correlation between money supply and the stock market. As you can see, the Fed has drastically reduced the money supply over the last year and a half. Basically, a reduction in money supply often slows down the economy. Another of our big four is corporate earnings or corporate profits. The premise here is that as corporations' profits go, so do their stock prices. And this is from the LPL Research Department, and it shows that during the first quarter of this year, 2023, earnings declined by 6% over the same period last year. This is especially concerning because stocks have gone up while earnings have gone down. We believe that something's got to give here. Next, we look at our big four as what we call the Fed's balance sheet. Okay? Fed's balance sheet. In recent years, with all of the social called quantitative easing measures that the Fed has done, their balance sheet has increased exponentially. This was especially evident post-COVID. Like with money supply, there's a very strong correlation between growth in the assets on the Fed's balance sheet and the stock market. These assets are reducing. The Fed is reducing its balance sheet, but it's been a very slow process. Last, but certainly not least, is the leading economic indicator index. The blue lines represent growth and declines in economic activity. The gray bars that you see going up and down vertically represent recessions. You'll see a pretty consistent pattern of what I like to call camel humps in this chart, in this index, prior to recession. So in other words, this index will begin to show weakness in the economy prior to the onset of a recession. As you can see in the top right of the slide, we've been in a pretty significant decline over the last year and a half as far as leading economic indicators go. At the bottom right, you can see in this box a pretty straight decline during that same time period. This is a great piece from our friends at Franklin Templeton. This shows a list of various things in the economy with signals showing whether they are in expansion, proceed with caution, or showing recession. The column there, kind of to the far left, labeled current as of April 30, doesn't show a whole lot of good news. Lots of red X's up and down, which indicate recession. We only have two yellow lights that are telling us to proceed with caution. Everything else on these indicators is decidedly negative. We've discussed in the past that GDP stands for gross domestic product. It's the bottom line report card on the U.S. economy. And when we say real rate of change, the real part is where it's been adjusted for inflation. So that's what we mean by real rate, okay? As you can see, GDP has been declining pretty rapidly over the last year and a half. This is a good tool that we use as it relates to assessing risk. Drawdown basically means how far an investment dropped from peak to trough during a specific period of time. Here we show drawdown in the S&P 500 over the last 11 recessions going back into about 1953. On average, the drawdown is around, during recessions, is around 30.77%. Last year's drawdown during the bear market in 2022 was in the low 20%. Does that drawdown increase if we in fact do go into a recession in the future? That's the question. What we call bear markets. Bear markets are markets that go down. Bull markets are markets that go up. It suffices to say that bear markets are bad. Here at the bottom of the slide, we can see that the average decline or drawdown in bear markets is about 30%. When these bear markets occur during recessions, the drawdown is about 36%. Bear markets without recessions average a loss of 23%, which is about what we did last year. To the right of the red percentages, we see how long it takes for the market to recover from bear markets. On average, it takes about 1.5 years to recover from a bear market. This increases to over 2 years for bear markets that happen during recessions. Pretty significant. So we've talked about market behavior. Now let's talk about investor behavior. Here you see average returns for different asset classes. As you can see, things like real estate and stocks perform very well historically. Almost all the way to the right, you see that the average investor has performed very poorly. So why is that? The greatest enemy of the average investor is the emotion and the emotional reactions of the average investor. We're typically our own worst enemy. Driven by fear and greed, the average investor will inevitably buy at the top because they're greedy and sell at the bottom when they get scared. I've seen this time and time again over my 25-year career. The worst, most dastardly thing that my industry has ever done to investors was providing online account access to our clients. Horrible thing we did. This, in my educated opinion, or is my educated opinion, but I think the data proves me correct, proves me right. The more that the average investor looks at their investments online, the more often they will react emotionally. Because of this instant access that we've provided them, we've created this monster, they can make very short-term evaluations on their long-term investments. As you can see, this can be a recipe for disaster. What do we mean by bad breath? Okay, bad breath. So while the market has recovered nicely from those lows in October 2022, the numbers that we see can be pretty misleading. Here's what I mean. More than 100% of the gains of the S&P 500 this year and so far in 2023 have been driven by just 7 stocks. Call them the Magnificent Seven, if you will. There are 500 stocks in the S&P 500. So only 7 stocks have accounted for more than the entire gain of that index for the year. If I take out those 7 stocks this year, the market would only be up by about 0.5%. So why do we care? We talked in our Feeling Blue in 22 report earlier this year about the dangers of quote-unquote average returns. I even gave an example that on average, Shaquille O'Neal and I are 6 feet 5 inches tall. On average, this is true, but it's also very misleading. Those of you that know me, that have seen me, know that neither I nor Shaquille O'Neal are anywhere near 6'5". And that's the problem a lot of times with averages. In a healthy bull or good market, we would like to see a lot more stocks than just 7 out of the 500 going up. This market so far this year is not behaving like a healthy bull market. Drilling down a little further, here's a note from Adam Turnquist of LPL. The mega cap technology companies have powered the broad market higher this year. In fact, the entire 8.1% gain in the S&P 500 year to date has been driven entirely by 6 mega cap technology stocks. Apple, Microsoft, Nvidia, Meta, which is the old Facebook, Amazon, and Alphabet, which is the old Google. So not only has the market been driven by a very small handful of stocks, but that handful of stocks is all concentrated in the technology sector. Having done this for quite a while, I just feel like I've seen this movie before, The primary driver of the market clearly has been technology stocks, big ones. The primary driver of these technology stocks has been artificial intelligence, or what we call AI. To me, this is very reminiscent of the dot-com bubble back in the late 90s. Back then, anything and everything tied to the internet went up meteorically. You see on this chart here. Now, even companies that have no association with AI whatsoever are mentioning AI on their quarterly earnings calls. I'm talking about companies that sell tennis shoes and dog food. They're mentioning AI. It's absolutely crazy, but what they're trying to do, I believe, is bring about some hype towards their stock and create some energy and help their brand. This is crazy, and I hope that this time turns out much differently and much better than it did back then. So investors have absolutely gone gaga recently over tech stocks. In this process, they've shunned dividend-paying stocks. In the teal blue here, you can see how dividend-paying stocks have significantly outperformed the stock market as a whole during periods where the Fed was raising interest rates. That's the purple. Blue is dividend-paying stocks. Purple is just the regular S&P. I think this chart actually shows this difference even better than the prior one. The orange reflects dividend-paying stocks in the S&P 500 going back quite a ways. The blue is the whole entire S&P 500. Again, dividend-paying stocks have dramatically outperformed the market over long periods of time. Dramatically. Continuing to beat the dead horse here, you can see in the orange the significant outperformance of the S&P 500 when you reinvest your dividends. And here's why I'm spending so much time talking about dividends. Normally, if I own a stock or a mutual fund, I can only make money one way. If the market goes up, I make money. If the market goes down, I lose money. Pretty simple. With dividend-paying stocks, I have the potential, at least, to make money 2 ways. If the market goes up, my stocks will probably go up. In addition, I have the potential to also make money by receiving my dividends. Shifting gear from the market or from stocks, let's talk about the consumer here. The consumer matters a great deal because they represent about 2/3 of GDP, of the economic growth. Big deal. Here's what's really interesting, though. Even with all of the fears of an impending recession, retail sales still remain very strong. This is a big part of what is keeping the economy afloat, even though the Fed is trying desperately to slow things down. The good news is that retail sales and consumer spending are up. The bad news, a tremendous amount of the spending is being done through borrowing. You have a very debt-ridden consumer right now. This is pretty sobering. Here you see a pretty dramatic increase in consumer loans. This is the highest going back 20 plus years. Also, keep in mind that consumers are piling on debt while the Fed is dramatically raising interest rates on that debt. So if the debt chart didn't bother you, this one should. Check out the delinquency rates on credit card and consumer loans. You often see very large spikes in delinquencies leading up early on in recessions. Take note on the far right that delinquency rates are currently higher than they were during the financial crisis of 2008. This slide just illustrates just credit card borrowing, not all consumer loans, but just credit cards. To the best of my knowledge, this is the highest credit card debt has ever been. Don't forget that credit card interest rates can be extremely high. My question is, how long before the overwhelming amount of debt begins to cripple the consumer? Just asking for a friend. In my opinion, though, there's a very good reason why the consumer continues to spend and borrow money. That reason is extremely low unemployment. So basically, the consumer right now can easily make minimum payments on their debt, again, for now, because they have jobs. Unemployment in this country is a ridiculously low 3.7%. During recessions, we see unemployment typically rise dramatically. So here's the deal. As the consumer, which again is 2/3 of the economy, loses their ability to keep buying stuff, it affects the profits/earnings of publicly traded companies. As earnings decline, these companies are forced to reduce cost to shore up their balance sheets and help their stock price go back up. The greatest controllable cost of most companies? Labor. If a large number of companies begin laying off workers, those workers will have a hard time paying down the mountain of debt that they have. This is a very, very real concern. As we discussed at length in our Fun with the Fed report last month, this is a slide from there, the Fed has several things on its wish list as it tries to tame inflation. One such thing is lower asset prices, specifically investments in real estate. Economists have long referred to something called the quote-unquote wealth effect. Basically, as the value of investment portfolios and real estate increases, the consumer becomes much more confident about investing and spending money. This could drastically increase consumer demand in an economy, thus contributing to inflation. And here we are. We have seen evidence that the Fed would like to see a reverse wealth effect in what they've done. As we discussed last month, the Fed would also like to reduce consumer demand with higher unemployment. Again, this could become a big problem for very debt-laden consumers. As we close, let's talk about what the bulls think, or what can go right. Again, bulls think the market's going up. The bulls who think the market's going up are looking for a soft landing for the economy. In other words, they believe that the economy will slow down, but not go into recession. There's also a growing number of bulls who believe that we have a no landing scenario. In other words, the economy doesn't slow down at all, just accelerates and goes on about its business. The bulls believe that corporate earnings, those profits, will recover to levels from last year, thus supporting the currently high level of stock prices. The bulls believe that unemployment will remain very low, thus empowering the consumer. Lastly, the bulls believe that the Fed will get inflation under control and that it will stay under control, again, without slowing down the economy dramatically or causing a recession. To be a bull, you have to believe that the Fed is going to get it right. You have to have a tremendous amount of confidence in the Fed to want to be an aggressive investor right now. And here's some pretty compelling evidence that's really encouraging the bulls. As of right now, there is currently more than 24 trillion, with a T, sitting in short-term cash, cash equivalents, and or money market funds. That is a lot of money that could be deployed and invested into the stock market. My concern with that theory, with that hope that the bulls have, is that these people holding all of this cash are earning a pretty decent rate of risk-free return right now, like 4 or 5%. These are the highest cash yields that we've seen in over 20 years. My concern with the bulls theory is that investors are being rewarded pretty well right now for taking no risk and doing absolutely nothing but sitting on cash. If that's the case, why would they want to take on more risk? Stay tuned. Next, let's talk about what the bears think and what could go wrong. Bears are people that think the market's going down. So the bears think that the economy could be in for a hard landing, basically a pretty severe recession that brings asset prices, stocks and real estate, lower. The bears are worried about a spiral of high, or at least higher, unemployment, leading to a reduction in consumer spending, which leads to higher consumer debt, defaults, and or lower corporate earnings. In our Fun with the Fed report last month, I showed my age by making a reference to Alfred E. Newman from the old Mad magazine. Here I'm going to really show my age by referencing Johnny Carson from The Tonight Show. You remember Johnny's character in the skits that he did? As Karnak the Magnificent, Carson would hold an unopened envelope to his head. He would answer the question first, then open the envelope and actually read the question. Hilarious stuff. That said, I'm going to do my best impression of Karnak the Magnificent and tell you what we think. We think that we could see a so-called rolling recession as we close out 2023 and move into 2024. Rather than seeing a harsh recession and tremendous drop in asset prices all at once, a rolling recession would entail the economy constantly absorbing recurring bad news. Think gradual recession. We think that you actually could see some interest rate cuts from the Fed later this year or early next year. But this is going to be much later than what the market has been hoping for during this recent rally. Honestly, we would not be surprised to see a decline in the stock market of somewhere between 5 to 15% by the end of this year. And while that may sound bad, remember that the market is up so far this year. That's not as bad as maybe you might think. We believe we will see some improvement in the bond market as rates decline, as interest rates decline, an expectation of the Fed gets put on the Fed wanting to cut interest rates. We believe that we will see flat to further declining corporate earnings profits. Go back to what we said about higher unemployment and a heavily indebted consumer. Earnings start to drop, companies start laying off, and then we start the spiral. Lastly, we do believe that we could see rising unemployment per the Fed's wishes. We believe this would not be a good thing for the economy, for the consumer, or for the markets. Please note that we don't see anything even remotely resembling what we saw back in 2008 with the financial crisis. We don't expect a repeat of that at all, but we do think we need to be prepared for some choppy times maybe ahead. So let's talk about some action steps for you and for us. We recommend keeping your greed reasonably under control right now. We also recommend a focus on some old school investment thinking. Focus on things like economic and stock fundamentals. Beware the hype. We'd like you to focus on multiple ways of making money, i.e. things with market upside that also have the potential to pay good dividends, option premium income, and interest. Focus beyond the last headline. Do not do minute-by-minute evaluations on long-term assets. In other words, stay off the dadgum internet and TV 24/7. Last and most importantly, stay in touch with your advisory team here at Income Solutions. We'll close here with a word from our lawyers and a picture of the official Lance Browning bobblehead. By the way, you know you've arrived professionally when you have a bobblehead. Other than not having nearly enough gray hair on top, this thing's pretty much a dead ringer for me. That said, please have a wonderful rest of your summer and don't hesitate to reach out if we can do anything for you. We'll talk soon. God bless.